Hi everyone. In Chapter 1, we have two exercises that we are going to review together. It's a very theory type of chapter, so there's not problems. It's just applying some of that conceptual framework that you already have learned a little bit about back in your prior accounting experiences, but we dive into it a little deeper. So on page 38, I'm looking at exercise 1-11. Identify the accounting concept that was violated in each of the following situations. So we have Pastel Paint Company purchased land 2 years ago at a price of $250,000. Because the value of the land has appreciated to $400,000, the company has valued the land at $400,000 in their most recent balance sheet. Well, we remember this from back in Accounting 111. That violates the cost or historical cost principle. Remember, in the United States accounting, we record everything at cost and leave it that way, unless there's an accounting rule that trumps that supersedes that. And sometimes we see that. For instance, if the value of an asset is lower than we originally paid for it, we may have to decrease the value of it, but we rarely, if ever, increase it. 2. Atwell Corporation has not prepared financial statements for external users for over 3 years. Well, they should have, and they should do that periodically, and that's determined by the periodicity assumption that says we are breaking our accounting cycle into artificial periods, and we should prepare financial statements at least once a year, one accounting cycle. The Klingon company in number 3 sells farm machinery. Revenue from a large order of machinery from a new buyer was recorded the day the order was received. Well, that definitely violates the revenue recognition principle. Remember, that principle tells us when we can record revenue. And we have a whole chapter on that. It gets very specific, the rules. But generally, what we say is revenue is recognized when we sell the product or perform the service. So when in this case, the buyer takes ownership of the product, would we record revenue? Not when we place the order, because the sale was not complete. In number 4, we have Don Smith is the sole owner of a company called Hardware City. The company recently paid a $150 utility bill for Smith's personal residence and recorded it as an expense. Well, I guess you can do that, but you've definitely committed a little bit of fraud there and violated the economic entity assumption. Now remember what that says. Separate entities keep their financial information separate. So a personal utility bill shouldn't be paid for and treated as an expense of the company, nor should an expense of the company be treated as a personal expense of the owner. Keep them separate. In number 5, Golden Book Company purchased a large printing machine for $1 million, which is considered a significant or material amount, and recorded the purchase as an expense. Well, it actually violates 2 policies, principles, how you want to look at them. The first is expense recognition. Expenses are generally services we receive from somebody else and have to pay for. So this was not an expense. Also, this was something we own. It's a resource that will benefit us in the future, us being Golden Book. So this should have been recorded as an asset. Then it would have been expensed through depreciation over the time it would be used. Materiality was also violated here. Significant items must be recorded properly. If this machine was $10 and they expensed it, probably not a big deal because it's not a material amount. That's the difference. Ace Appliance Company is involved in a major lawsuit involving injuries sustained by some of its employees in a manufacturing plant. The company is being sued for $2 million, which is a material or significant amount, and they're not insured. The lawsuit, was not disclosed So they didn't tell any of the decision makers in the notes to the financial statements or in the financial statements that there was a lawsuit because no settlement had been reached. Well, that violates full disclosure. We should record all information or disclose all information that's material in amount, and material in amount means it would change a decision maker's mind. So that $2 million would change a decision maker's mind depending on the severity of the lawsuit. If they're really going to lose it or not, that's what determines if it should be a actual journal entry to record the lawsuit as if it was already lost, or if it's just a note to the financial statement. Okay, so that's just some application of those various concepts in that conceptual framework. In exercise 1-13, we're looking at the basic assumptions and principles again. For each of the following situations, state whether you agree or disagree with the financial practice employed and explain the reasons for your answer. Well, we give you the answer, right? But let's take a look. The controller of Ldunn Corporation increased the carrying value of land from its original cost of $2 million to its appraised value of $3.5 million. Well, we just talked about that. You should disagree with that because they just violated the historical cost principle. The president of Vosburg Industries asked the company controller to charge a miscellaneous expense for the purchase of an automobile to be used solely for personal use. Wow, there's a whole bunch of stuff happening there. Now, that is an economic entity assumption violation. If the president is going to buy it and personally use it, he should record that and buy it through his personal accounts, not the business. And then on top of it, try to expense it. Hey. At the end of its 2020 fiscal year, Dower Inc. received an order from a customer for $45,350. The merchandise will ship early in 2021. Because the sale was made to a longtime customer, the controller recorded the sale in 2020. Boy, these look a lot like the ones we just looked at, right? This is a violation of the revenue recognition principle. I don't care if it's a customer you just met or a longtime customer. You don't record revenue until the sale is complete. Number 4. At the beginning of 2020 fiscal year, Rossi Imports paid $48,000 for a 2-year lease on warehouse space. They recorded the expenditure as an asset to be expensed equally over the 2-year period of the lease. Well, yeah, that's right? You're not supposed to expense an item until you actually receive that service. It occurs. So if you paid for insurance early, the day you pay for it, it's an asset. It's insurance coverage that is owed to the company. As the company receives its coverage or time passes, then the part that is used up is expensed. So that is the correct way of accounting for that. Remember prepaid insurance. The Reliable Tire Company included a note in its financial statements that described a pending lawsuit against the company. Hooray! Yes, that's what we should do because we're conforming to the full disclosure principle. So that's correct. The Hughes Corporation, a company whose securities are publicly traded, prepares monthly, quarterly, and annual financial statements for internal use, but disseminates to external users only the annual financial statements. Okay, here's the issue. First, I'm looking at going, well, that's not really a problem, but what changed my mind? I'll give you a second, see if maybe you picked it right out. It's a publicly traded company. The SEC requires quarterly financial statements and financial information be reported to them. So they're not only going to be giving out annual financial statements to the public, external users like the Securities Exchange Commission, but quarterly as well. They're not going to give monthly, but quarterly. So this is a violation of the periodicity assumption. Okay, so that's how we would apply these assumptions, constraints, principles. Some of them, or most of them actually, you've already learned, but you learn them sporadically throughout Accounting 111. But in our accounting world, this is what all these things together are our basic framework. This is what all of our rules are based on. So we have definition behind our rules. Why do we have to record that at what we paid for it? Oh, the cost principle makes us do that. Why can't we record that as an expense? I want to record that as an expense. Oh, the expense recognition. Okay, so it's our definitions behind our rules. So it's very important we're familiar with these. So make sure you're doing your practice and your graded problems for this chapter, and any kind of questions you may have, please post to the discussion board.